Yeah, so someone bought 11,000 calls, the bull spread between 15 and 20,000, December 2026. The purchasing came after the crash, not before the crash, to me, which is the key point. So some large player used the washout to build a 1.1 million ounce tail risk position at a cost of about $3 million. And it only pays out if metals triple from here, if gold triples from here. Now, to me, it's like he's not betting on gold as much as he's betting on debt and war and inflation and energy choke point and fertilizer and all this stuff that's going on along with the de-dollarization. I know that seems kind of crazy, but it seems like a pretty expensive bet. And if you look, it's all over Twitter. They're talking about it. Someone evidently believes that by the end of the year, gold will be between $15,000 and $20,000, enough to buy 1.1 million ounces worth of gold options.
Most people see falling prices and assume something is breaking. But what if the real most people see falling prices and assume something is breaking? But what if the real signal isn't the drop, it's who's buying into it while everyone else steps back? Andy Schectman argues that the recent decline in gold and silver isn't driven by weakening fundamentals. Instead, it reflects a recurring dynamic: paper markets dictating short-term price moves, while informed players quietly accumulate physical metal in the background. In that framework, lower prices aren't necessarily bearish, they're part of the process. He points out that much of the recent correction was structural. Rapid increases in margin requirements, combined with forced ETF rebalancing, triggered a wave of liquidations among leveraged traders. That selling pressure pushed prices down quickly, but it didn't come from a shift in underlying demand. Beneath the surface, the physical market tells a different story. China has sharply increased silver imports, exchange inventories are being drawn down, and large volumes of metal are being taken for delivery. At the same time, major institutions appear to be covering short positions near market lows, suggesting calculated positioning rather than stress. Schectman's core argument is that price can act as a form of misdirection. It reflects liquidity and leverage in the short term, not necessarily the true state of supply and demand. If that's the case, then the current weakness may not signal the end of the trend but a transition point, where ownership is quietly shifting into stronger hands. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
Well, I mean, I think that the gold and silver coming down, Andrew, changes nothing. It's the same game that's always been played. The paper markets push price around and strong hands are accumulating the real metal. I don't think lower prices are weakness. To me, they're an opportunity this time. And I mean that sincerely, because this is accumulation. This is positioning. There's a buyer for every seller, and the buyers of this panic are the smart money traders, the people that know the fundamentals haven't changed. And to me, this is only normal sediment reset to build a fuel for the next leg up. Let's talk about silver for a moment. We talk about this movement down, this correction, which the Bank of International Settlements came out and said, look, this move in their mind is structural, not fundamental. Well, what does that mean? Well, they say that it had to do with the massive influx of metal running into the levered ETFs that all had to rebalance in January, along with the massive increase in margin requirements on the CME that went up over 300% in a month, specifically designed and targeted to squeeze the speculators. Had much more far-reaching effects into the retail industry and the refining industry here in the States. But what it really did is it absolutely blew up all of the speculators who had to post 300% more margin in a period of a month to keep their positions open. When they didn't, selling beget selling, beget selling, beget selling, beget selling, and bang, the price collapses. We see banks like JP Morgan covering at the very bottom. We see massive deliveries, not just on COMEX, LBMA, or Shanghai, but I think it's very interesting. Let's start with China. Bloomberg just reported that the Chinese custom data says that 790 tons of silver were imported by China in the first 2 months of the year. February alone, 470 tons, the highest monthly import volume ever recorded, while the price got its teeth kicked in. So while paper gets pushed down, China was vacuuming up physical supply at every available shelf on the planet. like it's never been seen before. And we saw 100 tons of silver leave the Shanghai market in the period of a week. So big money is standing for delivery across the globe. We've seen in the last 6 months, 200 million ounces of silver in the registered category, September of 2025. 6 months later, we're right here and it's about 78 million. So over 120 million ounces have been drawn down in 6 months. Who's doing this? We look at February here in the States, which is a non-delivery month, right? You can take delivery, but not a primary delivery. Roughly 25 million ounces delivered on COMEX. One of the smaller deliveries we've seen in the last year and a half, but 160% of what deliveries could explain alone, roughly 38.5 million ounces, left COMEX. That's over 2 million pounds. Who is arranging the logistics for this? Who is putting all of those bars on semi-trucks and driving down the street with insurance and logistics, and where's it going? Is there a coincidence that it has been classified a critical mineral? I'm just saying. But we're seeing the same thing in gold too. Massive deliveries, huge deliveries. And to me, Andrew, price is just a tool of misdirection. Now, if I had to be completely honest, I feel that indeed this correction was completely structural because of the structured changes, not fundamental. I appreciate that. And you can look at the March 20th Commitment of Traders report, which shows that at the very bottom, JP Morgan closes 633 short contracts, or 3,165,000 ounces of silver. Just happened to be right at the bottom. And let's not forget about the 4 glitches we've seen, 2 to the up, 2 to the down, where the price fell, the circuit breakers glitch. Sorry. And on the price up on Thanksgiving night, the servers of the CME group overheat just in the 1,000 commodities that are traded, just in gold and silver, overheat on Thanksgiving night because everyone's trading. Or how about the fact that so far in March, we've already seen 12,532 gold contracts stopped or delivered 1,253,200 ounces of gold, or 8,713 silver contracts. Now, where's my phone? 8,713 times 5,000 is 8713 times. So far there's been 43,565,000 ounces delivered, stopped. It's called issued and stopped, delivered to the COMEX market. And the month isn't even over. So you put those two numbers together, you're $7, $8, $9 billion worth of gold and silver, again, delivered. And no one's saying, who's doing this? That's the part that I think is being massively missed. These people do not screw around at this level. This is why I believe the lack of trust in these markets is growing to a point where now you have India coming out and saying, as of April 1st, we're no longer using the London benchmark for our ETF valuations. We're going to do it ourselves. You are having people pull their metal out of the system.
What if the biggest clue in this entire move isn't the crash, but what happened right after it? Andy Schectman highlights a striking example. Right after the sell-off, a large player stepped in and bought 11,000 December 2026 gold call spreads, targeting a range between $15,000 and $20,000. That's exposure to roughly 1.1 million ounces of gold placed after the washout, not before. The cost? Around $3 million. The implication? This isn't a bet on short-term price action, it's a calculated position on extreme macro outcomes. Because to justify that kind of upside, you're not just betting on gold. You're betting on debt expansion, currency debasement, geopolitical tension, and structural shifts like de-dollarization. At the same time, the usual narratives don't fully hold up. Rising interest rates are often cited as bearish for gold, but in recent years, gold has advanced even as yields climbed. The relationship isn't as simple as it's often presented. It's selective, used when convenient. Schectman's broader point is about perception. Markets react to headlines, rate hikes, dollar strength, short-term volatility, but those reactions often mask deeper positioning. Fear drives retail behavior, especially during sharp drawdowns. Professional players understand that. When prices drop 30 to 40% quickly, it shakes confidence. That's the mechanism. But if the underlying move is structural, driven by margin pressure and forced liquidation, not fundamentals, then the real story isn't panic selling. It's who's quietly stepping in while that panic unfolds. Let's get back to the interview.
Yeah, and Jim used to call it MOPE, Management of Perception Economics, that they come in to manage the perception. I was going to ask you a question, by the way. Have you seen that story about someone buying 11,000 December 2026 bull spread calls between 15 and 20,000?
I haven't actually, Andy. I haven't
Yeah,
seen
so someone bought 11,000 calls, the bull spread between 15 and 20,000, December 2026. The purchasing came after the crash, not before the crash, to me, which is the key point. So some large player used the washout to build a 1.1 million ounce tail risk position at a cost of about $3 million. And it only pays out if metals triple from here, if gold triples from here. Now, to me, it's like he's not betting on gold as much as he's betting on debt and war and inflation and energy choke point and fertilizer and all this stuff that's going on along with the de-dollarization. I know that seems kind of crazy, but it seems like a pretty expensive bet. And if you look, it's all over Twitter. They're talking about it. Someone evidently believes that by the end of the year, gold will be between $15,000 and $20,000, enough to buy 1.1 million ounces worth of gold options, or about a $3 million out of the money gamble. I don't know. I found it interesting to think, does someone know something we don't know? Is someone just pissing away some money? I guess we'll have to see. They say, well, gold doesn't do well in a rising interest rate environment, and the 10-year Treasury rose 40 basis points in less than a month. Okay, normally true. Higher interest is not great for gold, but is it? Because they use that as a convenient argument. But what about the last couple of years when rates went way up and gold was marching to all-time highs? In other words, the gold went up in the face of rising interest rates, and when it's convenient to talk about it, great. When it's not, they ignore it. And the short-sightedness of the West, it will be, I think, will be one of the biggest problems that they will face, because again, we're playing checkers, and the rest of the world, or at least the global South, is playing chess and looking at things on a much larger scale and a much bigger macro picture, where we're looking at things where Fed Chairman Powell says, well, we may actually have to raise rates, and bang, that's the catalyst to smash it again. Well, really? Who cares that rates are at 4.4%? Because this is the same, you had this sustained breakout. People thought maybe it's actually changing, and then it got hammered. They're frightened, and I understand that. Like I said, emotions are very strong, fear being the strongest. And, this is what the professional traders understand very keenly. When you see 30, 40% get wiped out in a very short period of time, it's very frightening. It's very concerning. And unfortunately, most people are not able to separate their intellect from their emotional pull. And so I would say that it's certainly done its job. The price certainly knocked a lot of people back a little bit, and that's why we have these discussions. You said something that I think is the catalyst too, and I think it's very important people catch what you said. You said, in essence, that there has been a temporary dollar bounce, which distorts things. And this is because everything settles in dollars. But it's not real strength. It's just forced selling, in my opinion. And that forced selling has created an environment where people are very afraid because they focus too much on the price and not on the fundamentals. And even the BIS said, this is not fundamentals, it's structural. Like you said, ETFs, levered, and like I said, massive margin increases. And just so people understand what I mean by margin increases, on December 1st, it roughly cost us $15,000 in a margin account to hedge 5,000 ounces of silver. If we have 2 million ounces of silver in our warehouse, like we will, you gotta have 20 million bucks in a margin account sitting there, right? 15 million, just sitting there to hedge your position so you're market neutral with your inventory. Within a month and a half, by mid-January, when the price collapsed, you were at $4,000 to hedge that same amount. They increased margin rates by 300%, and that squeezed everybody, along with the ETFs rebalancing. And that really frightened people this time because, you know, this was the largest silver drop ever. And that's why I took comfort in the BIS coming out and saying, look, y'all, this was structural, not fundamental. Nothing's changed. And I believe that. And that's the message I would like people on this side of the pond and on that side of the pond to understand.
Price declines, leveraged liquidations, and shifting narratives all point to a market driven more by structure and perception than by any real deterioration in fundamentals. Beneath the volatility, physical demand remains firm, inventories are tightening, and large players continue to position strategically, often during periods of maximum fear. The divergence between paper pricing and physical accumulation suggests that current weakness may be less about true value and more about temporary dislocation. If that's the case, then this phase is not signaling exhaustion, but rather a transition where ownership consolidates into stronger hands ahead of a potentially much larger repricing driven by macro forces already in motion. If the current price weakness is primarily structural and driven by forced liquidation rather than fundamentals, what specific signals would confirm that a true transition into the next major upward phase has begun, and how quickly could that shift unfold once physical supply constraints start to dominate pricing? So, stay tuned for clear, data-driven insights into the financial system. Don't forget to like and subscribe so you never miss our weekly updates. Thank you for your continued support, and we hope you enjoy the video.